Imagine having access to free money. Capital you can deploy when you need it at zero cost. That's the secret weapon Buffett's used for decades. And today, he reminded his shareholders why float is still the key play in his playbook. By the end of this video, you'll master 7 timeless key lessons Buffett's used for his investments. From float to the casino versus cathedral metaphor, and you'll also know who is taking over the helm as CEO, with Warren Buffett announcing he is stepping down and handing over the baton. Now, let's unpack those lessons. Lesson 1, float or near zero cost capital. Berkshire's insurance businesses generated $173 billion in float. Float is premiums held before claims are paid that Buffett likens to free money, providing a pool of capital that costs virtually nothing to be deployed. With that float fueling Buffett's war chest, he turns to where capital should and should not be tied up. Lesson 2, Buffett focuses on balance sheets over income statements. Buffett explained, "I spend more time analyzing balance sheets than I do income statements." Over an 8 to 10 year time frame analyzing balance sheets, you get to see what's real and what's hidden. This focus reveals durable assets, manageable debt levels, and contingent liabilities that quarterly earnings can hide. You want to see companies with rock-solid financial foundations and not just focus on short-term earnings reports. Once you know a business's financial health, the hardest decision oftentimes is simply waiting. That brings us to lesson number 3, patience and cash discipline. Buffett noted, "We came pretty close to spending $10 billion within this quarter, and they would not hesitate to spend up to $100 billion if they saw the right opportunity." That discipline has driven Berkshire's record $347 billion cash reserve, ready to deploy when markets dislocations create genuine value. The cash that Berkshire has is a significant competitive advantage, and it allows them to weather any storm and take advantage of a crisis. In terms of crisis, Buffett notes that stocks are the best place to deploy capital. This brings us to lesson number 4, stocks versus real estate. Buffett notes in the US, there's so much more opportunity in the securities market than there is in real estate. Buffett noted, because real estate deals can take years to negotiate, whereas stocks allow instantaneous action. But to act in markets, you need the right mindset, bringing us to lesson number 5, temperament over timing. Buffett warned, if you get frightened by markets that go down or you get too excited by markets that go up, you've got to check your emotions at the door. He stresses emotional resilience over any attempts at timing the market. But not only can emotions affect market timing, they can also affect how you look at businesses. The highest flying sectors aren't immune to change. This brings us to lesson number 6, where Buffett speaks of capital-intensive business models. Buffett observed that big tech, prized for being an asset business, now faces exploding AI infrastructure needs, with big tech companies working more like utilities, having extreme capital-intensive costs up front. Don't assume a business's model remains static. Companies change, business environments change. You have to reevaluate when the fundamentals change. But through it all, keep your eyes on what truly matters. That brings us to our final lesson, the cathedral versus the casino. Buffett likened capitalism to a magnificent cathedral of real economic value, but warned it comes with a massive casino of speculation attached. The basic game is so good that you don't need to worry about borrowing money to try to make more profits or buying junk securities just to find another sucker that you're going to be able to sell it to at a higher price. Having mastered the art of focusing on long-term value versus short-term noise, Buffett also noted the policy backdrop that shapes the market. Speaking on the macro environment, Buffett touched on tariffs and physical spending. Buffett warned that tariffs are an act of war that risk geopolitical instability, and insisted that trade should not be used as a weapon, urging cooperation for a prosperous world. He also labeled U.S. deficits as unsustainable over a long period of time, saying that while America is still the luckiest birthplace in the world, its bureaucracy and debt load scare him more than any market swings. With that macro framework in mind, they did touch on the core businesses at Berkshire Hathaway as well, where policy meets practice. First, starting off with autonomous vehicles and its impact on car insurance. Jane, the insurance mastermind at Berkshire Hathaway, cautioned that self-driving cars will dramatically change auto insurance. Fewer accidents mean lower premiums, but liability shifts to manufacturers and repair costs rise. New technology could threaten the auto insurance business, but that opens up areas for opportunity. Energy infrastructure build-out is going to be massive for these new technologies, and Berkshire Hathaway has clear opportunities here. Buffett compared the U.S. power grid overhaul to the wartime shipyard surge, noting Berkshire's private capital, expertise in generation and transmission can upgrade national infrastructure at scale. And after laying out both his timeless lessons and strategic business imperatives, Buffett closed the meeting with his final announcement, noting that tomorrow Berkshire Hathaway is going to have a board meeting, and that Greg Abel should become the CEO of Berkshire Hathaway. Buffett noted that he will still hang around in an advisory capacity, and he will be passing off an over $1 trillion business empire with over $347 billion in cash and timeless wisdom to Greg Abel. Closing out, leave a comment below letting us know which timeless Buffett lesson you're going to adopt first. As always, like this video and subscribe for more.